Hello, it's Bob. Still in this lecture, we will continue talking about accounts receivable, chapter 9. We're going to talk about estimating bad debt expense. So now we're still on the allowance method rather than the direct write-off method. So we are doing the allowance method, and now we're going to talk about how to come up with the amount that should be in the allowance. So once again, this is kind of like a chapter 3 adjusting process entry, where we're basically taking a look at the receivables, and we're trying to say, well, how much of those receivables are going to be uncollectible? Two methods we can do to do that. One's the percent of sales method, and the second is the accounts receivable method. So we can either look at the income statement and say, well, these are the sales that we made on account, and we know that in past history, part of those sales will be uncollectible. And that's what we're trying to do, remember, is to match up the expense of the uncollectibles to the revenue in the same time period. Or we can take the balance sheet approach, and we can say, well, this is the amount in receivables on the balance sheet. Let's see how much of those are going to be uncollectible. So we're going to say percent of sales method first. We would do a fairly simple calculation. We'll just take the current period sales and multiply it times the bad debt percent. You might be asking, well, where would you get the bad debt percent? And of course, that would be based on past history of uncollectibles in the past and or industry data. So we're going to say, well, based on the past history, so much has been uncollectible, in this case, 0.6%. Therefore, we're just going to take our sales, in this case, the 400,000, times the 0.6%, and that means that of those 400,000 sales, 2,400 would be uncollectible. So what would be like our chapter 3 adjusting entry as of the cutoff date at like December 31st? We would debit bad debt expense 2,400, recognizing the expense related to these sales that has not yet happened, but we think is going to happen, in that these aren't really sales. We're not going to get the money on them based on past history. And then we're going to credit the allowance for doubtful account, which basically reduces the net receivable, the balance sheet, the amount that we think we're going to collect sometime in the future. Then we're going to use the aging or receivable. So this is the other method that we could use. And generally, we're going to use some type of aging in my experience on this. So that would be, instead of just taking the sales and multiplying it times a percent, and a lot of times this method actually makes more sense to me. Classify each receivable by how long it is past due. Each age group is multiplied by its estimated bad debt percentage, and estimated bad debts for each group are totaled. So this, to me, seems more precise of a way to come up with the bad debt type number, and that would be, well, we're going to look at an aging report. This is the amount that people owe us, and we're going to say, well, how past due of it? People owe us this much money in the receivables as of the cutoff date. And if it's not past due, well, then we're more likely to receive it. So we could say, like, there's 2% that we're going to get there based on past history. And then if the older it is, obviously, the more likely we're not going to get it. So if it's 1 to 30 days past due, and the amount that we're not going to get is probably going to go up. If they haven't given it to us and it's 31 to 60 days, that it's more likely we're not going to get it. Way over here, if it's over 90 days past due, then we have a 40% likelihood of that past due amount not being paid based on past history. So it's a bit more complicated of a calculation, but it may be an attempt to be a little more accurate of the calculation based on the history of the debt that is outstanding, and then coming up with percentages based at the different levels. In this case, though, we'll come up with our estimated uncollectible amount. Now note that when we're changing the balance sheet side of it, we have to think about what's already in the bad debt expense, because when we're looking at the income statement and we're trying to think of how much of those sales are not going to be collectible, we don't have to think about what's already on the balance sheet. But in this case, we're thinking about how much of this 50,000 on the balance sheet are not going to be collectible, and there's already going to be an amount in the allowance. So whatever amount is in the allowance now, we need to adjust it to that, to whatever our new number is. So that means that if, in this case, there was 200 left over from the allowance last time, because it's just an estimate, and therefore we want it to be 2,270, therefore the adjustment has to be the 2,270 minus the 200, or the 2,070. So the difference being that we need to make the allowance whatever we think it should be based on this calculation, rather than just taking the sales and estimating those sales for that time period being uncollectible.